Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, April 11th, 2023. It is 11 after 10 o'clock Eastern Time, so I'm starting the video. And turns out the pool demo folks haven't showed up, and that's typical down here in Southwest Florida, especially Posty. And people tell you they come and they don't come. It's just kind of the nature of things down here. Anywho, as long as I can do a video, I wanted to get one out to you since it's nice and quiet. And again, that's not going to last long. They hopefully will come tomorrow. Wanted to do this for you. Go over just briefly, and I know it's kind of monotonous going over the charts. Nothing's changed my outlook, but I'm also going to speak to some of the comments on the front page. And first of all, let me say this, that I not only welcome all comments, I actually encourage opinions and sharing charts and outlooks that differ from my own, whether they outright question what I'm seeing or you're sharing just something else. Please bring it. This is the last thing that I want this site to be, with the comment section, all that, is a follow me site and a bunch of minions or clones thinking the same thing I think and reinforcing my biases and not getting me to second guess anything. So I'll speak to Jeff and some others on the most recent comment I checked this morning. I just looked at the last post and pretty much questioning my bearish outlook and hey, we should be buying dips. This market's going higher. It refuses to go down. Let me share my thoughts on that. I'm going to go over charts. I'm going to and all the way out to the long-term charts. I'll try not to make this one of those 45-minute videos. I think I can do this one in 30 minutes or less. But I'm going to show you different time frames and share my thoughts with you. And really, how to let me just start out by saying how best, in my opinion, to utilize this site. First, let me say this. I would not be doing what I do, as far as right side of the chart, having it a subscription service if I didn't think it was value added. I am first and foremost a professional trader. I've been doing this on my own as an individual trader and making a comfortable living off it. It wasn't always comfortable. There were periods, early on, drawdowns, big gains, and over the years, those have kind of smoothed that out. And my background, I was out of college, a stockbroker, started with Merrill Lynch and went to some regional bank programs, worked there, 13-year career, walked away from a lucrative career, trading, working as a financial advisor to chase my passion of trading stocks. And what the tipping point was is I was doing it more and more increasingly, actively trading. And if you're a broker, stockbroker, there's issues, front running and all other kinds of issues where if you buy and sell something and then you recommend it to your client, they buy it, then there can be problems there in the compliance department. It's increasingly frowned upon that, and at one point I had to make a decision to either give up trading or give up the career as a financial advisor with all the licenses and everything came with it. Fortunately, it was a pretty easy decision. It was one of the regional banks I'd worked for at the time. After several, Huntington, Fifth Third, for their investment, for their brokerage programs, AmSouth, and they sold out to regions, and one after another, these regional banks, there was a lot of merger and acquisitions, and have been really since the last 20 years. But anywho, that was my window to go ahead and give my notice, and so I just wanted to say that, and that's what I've been doing since 2007. That was early in the beginning of 2007, trial by fire, for right before the top of the great bull market that ended in October of '07, and I did flourished in that bear market, and so far doing very well in this one. So I just want to give you my background. Now, where I'm going with that is. I view this, it's not a follow me site. I think it's one of the proverbs from the Bible, give a man a fish, you feed him for a day, teach a man to fish, feed him for a lifetime. I don't pretend to have all the answers, and I don't certainly don't guarantee anyone's going to be successful by following what I do. And again, it's not a follow me site. I provide analysis. You know me, I'm going to give you my opinion if I have one. I'm going to tell you when I don't have an opinion or a strong opinion on something, and quite often I don't. There was months this year that I didn't even update crude oil because it was in trading range. I didn't have an opinion. When I see something that there's an opportunity or something stands out, I'll share it with you. So I do have my convictions right now. They haven't wavered in the last couple weeks. I see what I believe to be one of the best technical and fundamental setups for on the short side for a swing or trend trade down in the market. So I remain bearish QQQ, favoring the Qs, but the market as a whole. And I fully acknowledge the what some of the subscribers have cited in the recent posts, the resiliency, the buying the dips, and we should be buying dips and all that. And I'm going to show you why that's not where I think that's just a short-term thing. We're in a trend. I'm going to show you those trends and really where we're at and give you my thoughts. And then ultimately, I want to say this. So where I believe the value, where you can take the most value from this site. In addition, I share trade ideas. I share, whether it's, and I try to spread those out among various asset classes. So whether you're an investor or a trader, there's diversification. There's pretty much not a security out there I won't cover. If you bring something to my attention, if it has a ticker and I can buy it with a few clicks of the mouse through my broker, I will trade it, whether it's futures, ETFs, stocks, commodities, crypto, you name it. I'll trade it if I can chart it and buy it through a broker. All right. So with that being said, the takeaway is where I think my skill sets lie is identifying not only chart patterns, bullish and bearish chart patterns. I tend to like calling turns in securities, tops, bottoms. I know that's many consider that a fool's errand, and yeah, you're not going to get it right every time, but when you do, the moves, payoffs can be pretty big, and it's just kind of evolved as my style. And that's not always what I'll do. I'll look at continuation patterns and buy when we're in a trend, as I'll highlight pullbacks to support on long trades, or in a downtrend, highlight rallies into resistance. So there's a lot there, but going back to that, so that whole pattern recognition and again, really being able to look at a chart and identifying what I believe to be key or salient support and resistance levels, trend lines, things like that are likely to produce a reaction. So therefore, when I'm highlighting, like I have take this example for the last few days, 313.62 on QQQ, big level, right? If you're a bull and you differ with me, I've given you my thoughts that I think this level is going to go, and we're going to do this, right? But if you take the other side of it, and like I said, one of the few guarantees I'll give you is that I'll be wrong, and I'll be wrong a lot. So if you are bullish and you believe there's just a lot of liquidity for whatever reasons, you believe the market's going to go up, take those same levels that I'm looking at to whether I have my fill of shorts or not. When I say it's an objective short level, I may be shorting that level or I may not, depending on how much I have at the time. But if I say it's an objective short level, a key support level, then that's the same level that you can use as a bull, someone taking the other side of the trade, to buy those pullbacks to support if you think the market's doing that. So I just wanted to share that. And I try to do that in every video, tell you key levels, key support levels. I'll share my thoughts if I think they're going to break or if I think it's a buy on a pullback to those levels. And again, I think if nothing else, that's a takeaway. So you don't have to be on the same page with me. I encourage you not to be. You'll never develop fully as a trader or investor if you can't at least at certain points in times, formulate your own bias and opinions based on the analysis you're getting, your own analysis, that of others that you follow, and again, that's what I view this site as, is a tool, and providing you those key levels, key developments to watch for, and then again, always looking at different securities where the next, where a move might be, whether it's crude oil, or gold, or natural gas, or whatever it is, or certain sectors in the stock market. All right, so with that being said, I'm going to go through the levels, and what I'm going to do here is just make a quick case of why I think the market's at a very critical technical juncture. I've said that for a while, and we're still there, and why I believe that at this time, although I can sit here all day long and make this a 2-hour video and show you every single chart, every single indicator, and I can make both a bullish and bearish case and tell you the market's going to go up or the market's going to go down. We all know that. The market's either going to go up or down from any point, right? But I'm going to show you, the charts that I'm putting the highest weighting on, and kind of that where are we at in that roadmap thing. I always use that analogy when you walk into a shopping mall and it gives you that little arrow that says you are here, or a theme park, Disney World, whatever, and that kind of where I believe we're at in the bigger picture of things. So that's what I'm going to do in this video. Okay, we'll just look at, let's keep it limited to QQQ and the NASDAQ 100 and S&P 500. So, I think, not to be the dead horse, but this is where we're at. We just put in this divergent high. We bounced, we broke out. This whole thing is a breakout, and that is on face value bullish. As I always say, it's bullish unless it fails. I've made it very clear. I believe it will fail. And again, I think we're looking at it's one of the best looking bearish setups I've seen in a long time. That doesn't mean it's going to play out, but that's again, I've showed you reason after reason. The market leading stocks, the big tech stocks, they're all telling me the same thing on the charts. The technicals are indicated, and there are times where you have and I'll tell you, fewer things actually are more bullish than a textbook looking bearish setup like we have now with Apple, Microsoft, Alphabet, and the big fangs, tech. And again, tech is the market, make no mistake about it. Utilities and REITs, they can do what they want to do, go where they want to go, but they're not going to move the needle on the S&P 500 and especially the NASDAQ 100. It's those market leading big tech stocks due to the mathematical weighting. And so again, that's where I think we're going to go. But what I was saying a minute ago, if we don't, we continue to power much higher, and I'll get to that in a second on the longer term time frames, then that is very bullish when you can take out divergences and overbought conditions and kind of override or power through those bearish setups. So keep that in mind. And in my opinion, we haven't done that yet. So therefore, I have no reason to pivot. I know it seems like, I don't know what I consider impatience. The fact that on the short trades that the dip buyers are coming in and pretty voraciously buying the dips the last few days. But again, the very near term, and that's again very near term, just late last week, we're stair stepping lower, but not really a whole lot lower. We need to go ahead and take out that 316.62, go down to the next target, and then you're going to have the earlier or additional makings of an early downtrend. I'm sorry. All right. Remember too, this bears repeating, we are heading into the thick earnings season. It's really going to kick off this Friday, in my opinion, with the big banks. That's where we get going, and that could set the tone. But then the most important week is at the end of the month, when those big market leaders like Apple, Microsoft, Alphabet, Amazon, Nvidia, all big tech tend to report around the same time, and that will the market will almost certainly, in my opinion, most likely at least, have chosen its direction. Does it want to power through these divergences, power through the resistance levels and key moving averages and everything else I'm going to show you in a second here on the longer term charts, or are we going to get rejected? It's simply a bear market rally in the latter stages, because this is usually what it looks and feels like. Make no mistake about that either, guys. This is turn off all the lines. I can guarantee you, if you're feeling bullish now, you are feeling really bullish right there, and wondering why we were shorting at that point. Same thing, why we were doing the same here and on these rallies and right there. So it's called recency bias. It's the the bias to where you assume what's happened recently will continue to happen. The whole theory. It's, what trend trend trading is about, or I'm sorry, momentum trading. And that's just going to go. Momentum traders get eaten alive in this kind of market. They do great, and it's been we're coming off one of the best buy the dip markets in probably in history. I don't know what the stats are, but and the big corrections, of course, the Fed didn't allow anything else to happen. The Fed came in with all heavy guns in 2018, 2019, and even really since 2008. And all right, let me get to some of the shorter term charts, then we'll jump out to long term charts and I'll wrap it up here. But I'm going to show you a few other indicators I haven't showed you in a while, so there's some new stuff in this video. Let me look at the very short term chart. This one I've been showing you recently. The NQ, last couple times I showed it to you. I first showed you last week with a 5-minute candlesticks, and then I zoomed out and put it on a 2-week 10-minute. And this is good for you active traders near term. If you look at this, you can just look for these little divergent highs. And remember, divergence is not a sell signal, but you want to align that with a support level break, whether it's an uptrend line or price support, horizontal price support, that is. And so you get the divergent highs, divergent high, correction. Small divergence, typically, not always, but typically the smaller the divergence, the smaller the correction. Bigger divergence, the bigger the correction. Divergent low, we rallied. Divergent high right here, you can see my divergence line, correction. And now divergent high, another correction there. Then I pointed out this volume at price histogram, and this shows you where people are, where the majority, at least for the past 2 weeks, have bought, and that's right here. You can see, and the bulk of them bought in this area right here. And so you have, this is support, where you see these you start to see these bars go out. So you had the second largest bulk of buyers was right here in that zone. And so the way it works is if we take that out, you can see it gets really thin after that, at least over the last 2 weeks. Now, if you go longer in time, these bars are going to change because you're going to have the trades that are to the left of this chart here. So that can help guide you in the very near term, but this is completely relevant pretty much to what I'm about to walk into, longer term charts. I'm going to show you pretty much the weekly and monthly charts and why, and show you where I think we are in the bigger process of things. And also remember, earnings week, whipsaws are what I'm watching lately. What it looks like to me with the Qs is the bots are playing. It's a game of ping pong with the bots. I'm talking about computerized trading, the robots, algorithmic trading programs, high frequency trading. They're just getting on one side of the trade. Things are going up. Then futures go down. That's where gaps come from. And this is just this is the machines playing with each other here, is my opinion. And that's typical when you head into a big earnings week. Yeah, I mean, we have CPI tomorrow. There's a lot on the economic calendar too. I keep talking about earnings, and so if you're frustrated lately, you should be. There's again, if you're speaking of the market, you may be trading individual trade ideas, and I'll look. I'll get to that in 1 second about some more long setups. There was a request for that, but that's the nature of the markets usually heading into a big earnings week, and you can see we've kind of flattened out. So we're really, here's where we're at today, and that's where we were back at the end of March. We've gone nowhere. So when I see the comments, oh, the market's only going up, well, we're kind of stalling out lately. Yes, the market's up since the beginning of the year, and was 110%, short bearish there, started hedging up, made that very clear, and made it very clear big tech was my favorite, buy the big techs, the market leading things, and then went to outright, closed out all shorts there, told you, went full long there with the heavy overweighting on the Qs. And that was earlier targets, and then that's what's panned out. Now we rallied up there, and then bigger picture is in the beginning of the year I gave you bounce target zones, and I labeled 2 of them. It's kind of messy here, that's my busy board. I gave you the most likely bounce target zone where I figured we would most likely bounce into. We hit that one. That was is that the red box? Yeah, that's the red box. We hit it there, and we popped into it and went into the I don't know why things move sometimes on this charting platform, into the max potential bounce target zone. So that was most likely, and this was max. What I mean by max doesn't mean we can't go any higher, not guaranteed. Where would fit well with my bear market narrative of expecting a bear market rally And if you're new to the site, since before this bear market started, or right around the top it did, what my prediction was, and I still wholeheartedly believe it's going to be a lot different from any bear markets that anybody in recent history remembers. We're going to go back probably 50 plus years. Most of them, really the only ones we've really had that I consider true bear markets, 2000 to 2002, and then 2007 to 2000, late 07 to early 09. So they were less than 2 years, give or take, 18 months. And I believe this one, because of the secular trend change in interest rates and other factors, I believe it's going to be a much slower roll, and so far it's playing out that way, and this is what I'm showing you in this one. We're going to get to the longer term charts. So short term, near term, this is what would give us an additional check mark, and a pretty big one, because that means this whole breakout will have failed. Usually if you break out, not always, but usually if you come back, you'll back test once and then off to the races. The fact that we back tested once, the dip buyers stepped in exactly where I told you last week I expected they would. I told you expected a reaction on that initial tag there of 313.62, and they did. They bought, but guess what? They wasn't a lot of they behind the first day, if that makes any sense. In other words, there wasn't a whole a larger subset of buyers besides the initial buyers. So that shows me waning momentum. That is also evidenced in the trend indicators. So this is speaking to those comments that some people might think that, oh my God, this is the most resilient market despite everything bearish. I know that the headlines couldn't be more bearish. The fundamentals could be more bearish, but are quite bearish, and yet the dip buyers continue to buy, but they're buying with a lot less vigor than they did before. Okay, so that's one thing, and that's very near term. And again, we're going to break one way or the other. Could it go to the end of the month when the big fangs report? Yes, but the charts to me are, like I said, I don't want to beat a dead horse here, but these are some of the best bearish setups I've seen in the market, and particularly among the market leaders, which are the market. Again, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta. Add them up and you will see. I haven't done the math lately, but historically, even the top 5 a few years ago made up over 50% of the returns of the NASDAQ 100. So I'm sure now if you include the top 7, which is Tesla and Meta in there, and maybe ASML, you're probably going to see that. And again, I just see really nice setups. And again, if those setups don't pan out, then wow, that's going to be very, very quite bullish in my opinion, very bullish. But I see a beautiful bearish rising wedge. I see a rejection of the downtrend line on Apple, and I see most likely a significant drop coming. All right, let me get to the other charts here for you. All right, let's just start out here, daily. Let's just do this, show you kind of big picture. And I'm going to go to my fib board. Here it is. Okay, so here's the big picture right here. This is the S&P 500. I'm on a daily chart. What you're looking at, these little lines right here, here, and here, these are Fibonacci retracement levels. And so we're going to focus right now. This was the high. The S&P 500 topped right around the first of the year. The NASDAQ peaked back in November here, but then had pretty much a double top. So we'll say they both peaked right there. And so I measured, these are Fibonacci retracement levels. So I measured, this is the dip all the way down to the lows. The lows so far of this bear market was in October, mid-October right there. So this purple line gives you the Fibonacci retracements from the highs, and this white line uses this last major reaction high right here. And so Fibonacci traders, or those that, whether you trade fibs exclusively or you incorporate them into your analysis as I do, what you like to look for are what we call Fibonacci clusters. And you can see when I put up these two, and what you want to do is what I did, major reaction highs and lows. And so using those two, again, that was, I believe, the most powerful bear market rally, and it's a clearly distinct reaction high, and of course the high and the lows. And you can see how well these fibs line up. There's a cluster right there. There's a cluster right there. There's a cluster right there. These are fib clusters. This cluster, so right here, is the 50% of the entire move of the purple line and the 78.6% Fibonacci retracement level right there, and that's what stopped the market cold so far. And what that means, that's a pretty much, especially from the, if you're looking at the big picture, that is a typical and just really a midpoint run-of-the-mill Fibonacci retracement. Usually there's nothing set in stone, but I usually like to use the 61.8, 32, the 32.8, which I think I turned off on the purple lines. Yeah, I did. Here, I'll turn it back on. The 32.8. No, I have it. 38.2. I mean, I'm sorry. 38.2 to the 50. Oh, there it is. Oh, yeah, I can see it. That's the 38.2% of the entire bear market move. There's the 61.8, and there's the 50 stop cold. That is your typical counter trend rally range right there. So again, you're measuring from there to there. So okay, so what I just did is just made the case that although this might feel like the most bullish rally in the world, and again, guys, maybe we do this. Maybe we just head on up here, and the bear market ended there, and I miss a lot of that, and give back a lot of the profits over the last year or so, by staying short right now with my swing and trend positions. But there's very little evidence. I think what probably the biggest case for the bull case right now that I'm hearing being made, and I'm even recognizing, is the fact that we're above the 200-day moving averages. And so I will acknowledge that. We took them out there. It's not unusual to pierce them. That one we stopped at the 200 exponential. I'm sorry, simple. We took them out there, and then we failed them. It's just been whippy trading. And when I go out to the longer term charts, which I'm going to do now, and this one's a little busy. This is my weekly. I have different boards, but I still have and maintain these longer term targets. LT, that's long term second target. There was a long term first target laid out around the beginning of the year. That was hit. And then this is long term T2, long term T3. And here's a trend line that comes in. Oh, let me just loop back to that last board because okay. So on SPY, this is my next bear market target it's got a nice fib cluster. So what you're looking at there, I shouldn't have moved away from this. This blue line right here goes way to the left of the chart. It's right off. It's exactly off the March 2009 lows. I believe it was March 6, 2009. The S&P 500 and most major indexes bottomed, and so that measures the entire bull market up to the highs right there. Right, that's where that line is. I'm gonna put it to the high, and you have the 38.2. So as far as this bear market goes, I consider COVID and the fourth quarter drop in 2018, even though they both exceeded that 20% drop high to low, or right at it on 2018, I consider those just corrections in an ongoing bull market that ended here. This was where it probably would have started, but it was, or even here maybe, but most likely here, and the Fed just wouldn't allow it. They went in with all-out nuclear option, gave us that little bolus of adrenaline there, and popped the market up a little higher. And again, so that is the bull market top. And I just wanted to point out, so far, so we have the worst macro outlook, in my opinion, fundamentally. The highest change in interest, the biggest increase in interest rates in history from the Fed, percentage-wise. And we haven't even hit a 38.2% retracement. Okay, so if you also look at where the COVID lows, this is where the market was pumped full of the juice from both the federal government and the Fed. That was the yellow line right there, gives you a nice fib cluster. That's right here would be a 61.8% retracement. That's the yellow line right there. And so that's a nice fib cluster. There's also a cluster right here, which we already hit. But this is where, if you want to know where I think the next leg down, if we get one, will take us, and it's going to be right there. And I'm going to measure it for you right now, and then we'll get away from this. That's going to be a drop of about another 21%, which is what I've been looking for roughly also in QQQ. All right, now let's go out. Let's just keep it simple, and I'll wrap this video up so it doesn't go so long. Let's go out to the longest term. Why don't we put up the S&P 500 here? We can use SPY, but we just go back longer with the S&P 500. And some of these trend indicators I've covered quite a bit recently. and a couple I'm going to pop up here in a second I haven't showed you in a while at least. And so the S&P 500, you can see it going back. If you want to roll all the way back into the early 60s, that's what you can do with this. And you can look at, again, let's just go to modern history right here, last few decades, and you can see there's the two bear markets I'm referring to. So when you just eyeball this chart, if I didn't tell you it was the S&P 500 and I showed you this chart and say, can you show me the bear markets and the correction, you would say these were bear markets and these were just corrections. There's the fourth quarter drop of 2018, roughly a 20% drop, close to it, a little over that in the NASDAQ, I believe. And then there's COVID, 36% drop in the S&P, but they were little blips, right? And you can see one of my favorite trend indicators is the 20-month moving average. I have an exponential in yellow, in blue, and I added recently the 20-month simple in yellow, and they do a phenomenal job. And I know if you've followed me for a while, you've heard me talk about these a million times, but they're just, it's probably, if I could only have one 401k indicator, if I was just going to sail around the world and not ever turn the TV on or read the paper or do anything, and I had to manage my money, it would be on using this one indicator. If I could only use one indicator, it would be this one. And I would be long when the S&P 500 was above the 20-month and short when it fell below it. And only it's a monthly chart. It only matters how you close the month. So there's a couple whipsaws, but very few. There's where you cross down. It caught almost all of the bear market at 2000 right after the dot-com bubble burst. Got you out of your longs and or into shorts if you are so inclined to short. Told you to get back in the market there. Captured almost the entire bull run from 02 to the 2007 highs. Pretty early on, got you out, and you certainly avoided the big meltdown in 2008. And yeah, it didn't get you in at the bottom, but it certainly, didn't, got you caught most of that bull market. And even that fourth quarter 2018, you had one single monthly close below, and then the very next month it would have said, if you were following this religiously, get back in. The rest, these were all right on, only to close the month back on the line. And again, if you have to sit there and zoom in and use a magnifying glass, then don't go with the signal. You want a clear, solid break below, and that's what you got back here. It gave you some pretty clear signals. And then look, like I said, if you took it in COVID, it got you back in the next month. And so again, that one tested it. The blue is my go-to, the exponential, and when you're above it, it often acts as support. That was an intra-month break to close right on it, and there was your confirming sell signal. Solid close. That red candle means we closed at the bottom of the candle. Rallied back to test it the next month, couldn't get through it. Next month rejected, closed below it, rejected off it, closed well below it. We've been back testing it since. This month is not over yet. And again, you don't want to, you want to see a clear recovery, solid recovery above, and that's why I added the 20-month simple as well. That would be, if you want to just, give it a little benefit of the doubt, use that simple in there. So there it is. By that trend indicator, and it's not the be-all, end-all, it says we're in a bear market. And so I know I've said this, so you got to pick a side. You can pick Switzerland if you want. You can play neutral and not be in the market, and that's probably a good thing for most of you listening to my voice, especially long-term funds. There's there's nothing wrong with being in cash. You're getting a lot better rate right now in a money market or short-term T-bills than you were a year ago. So you can wait it out and see who wins this battle, bulls or bears. But right now, when you are in a downtrend, this is trading 101. In a downtrend, you want to add to or short rallies back into resistance. So that's what you have right there. You also have this trend indicator down below, the PPO histogram. When it's red, you're in a bear trend. That was the entire, or not, but most of the market, bear market in 2007 to 09. It caught all these. That was a nice correction. So basically, you want to be long when it's green, right? It's a trend indicator, and that was doesn't look like much, but it was almost 2 years, 18 months of sideways to down action in the market, and it would have gotten you out of there. And so it's just another trend indicator that as of now, including this one, is still red, completely unrelated to that trend indicator. So I'm showing you my long-term trend indicators, and I've showed you these quite a bit recently. I'll show you one more here, two more. Let's put on, let me park the other two so we can see these well. PPO, park that back up here. Where am I going here? Okay, we've got the ROC12 and this one I haven't showed you in a while. I've shared it over in the past. Where did I put it? I thought I added it on here. Let me just double check. Percent above the... Okay, so apparently I have that one on a whole nother board layout, so I'm going to replicate it for you and show you how to do it. It's a little hack I came up with a few years ago to make a custom histogram if you're trading with moving average pairs. So what I did is just, on TC2000 you add a plot, and your plot, just type in MACD, and that's what I put up here. And then take away the signal line, which is a 90 MA, and then go into the MACD settings. And you can do this on other programs I've done on stockcharts.com. So we're going to do a 10-6. Now you can do this with any pair. And what you want to do is change it from line to a histogram, and then negative. I like to do negative color value, so green is bullish, red's bearish. There's your trend, and now that's the 10-6 EMA. And so what this tells me, this is a visual representation of the, if I had on here, and I don't want it on there because I don't like busy charts, and it would be hard to differentiate the lines, but if I had a 10 period and a 6 period moving average, that's on a monthly time frame, so that'd be your 10-month and 6-month moving average. Right here, remember, that's just the 20-month I already showed you, but you'd have two lines similar to this, and when those lines made bullish and bearish crossovers, meaning the faster a bullish crossover when you're using moving average pairs is when the faster moving average crosses up above the slower moving average. So in that case, the 6 is faster. That's when you get a bullish crossover, and it's also a very good trend indicator. So that's what I'm showing you here. So we're rolling back again. Remember, we had a Super Bowl back in the 90s. This is, remember, again, going back to the early 80s, interest rates peaked, and then we started a new secular trend, and that really kicked in full gear once rates started to really continue to fall here in the 90s. We had a super strong bull market. There were certainly some corrections along the way, but this indicator said be long and strong, the 10 EMA. That was a big drop in the early 90s. Well, technically a bear market, better than 20%. And it did, I'm sorry, it went red right there, the histogram. Oh, looking at this, I inverted the numbers. Okay, the short should be 6, the long should be 10. I was looking at that, I'm like, oh, that's upside down. There it is. Yeah, that obviously 10's longer. And you can see there was the inversion. It caught that correction. And again, just a phenomenal trend indicator. This said this was, with those few little exceptions, they're months each one. You have to zoom in tight. You might not see it in the video. There's about 5 months there, and that was a sizable correction bear market back then. And other than that, it's done just a phenomenal job. And this is one of many long-term trend indicators. I don't cover this one often. Why? Because it hardly ever changes. It told us that's the bear market, again, 2000 to 2000 and March of 2000 was when the NASDAQ peaked. The S&P held out a little longer and then finally buckled. And again, imagine being, just using this one indicator. And I like to use them all in conjunction. That's why I'm doing this video. That's why I talk a lot, and that's why these videos go so long. There's not any one indicator. Use them all collectively. There's that great bear market, the Great Recession, 2007 to 09 lows. It said bearish. That caught that little correction. But other than that, you had your sell signals. Some of these I would consider whipsaws. By the time the month closed, you got a red bar. If you got out of your longs, yeah, you got in and then the market started going up. But again, you captured 99% of the market using, again, that one indicator. And what it's telling me right now is it's still bearish. And yeah, you might say, well, it's coming up, Randy. Sometimes it looks like it's coming up. Again, I also expect this bear market to play out a lot longer and much, much differently than these two. So I wouldn't be surprised to see, we're coming close, but we're still on that sell signal. And now if this starts to go green, then that's one. Down here, you also have another indicator. Let me just squish this one down or park it back over here. This ROC 12, sometimes I'll toggle that to an ROC 13. That means rate of change. And again, it's another one that's done a great job of saying bull trend, bear trend, and capturing the bear markets with very few whipsaws. Okay, to go to 13, you might clear that, one of those or two of those bars out. But this is still on sell territory, and you can see back in 2002, well, you might not be able to see, well, when I zoom in, it looked like right here, right around when everyone thought the bear market, a lot of people thought the bear market would be over, looked like you were going to make a bullish crossover, and you didn't. You got rejected on the back test when those two lines tried to cross. Again, you don't see the moving averages here. The histogram just shows you when they cross. And so I suspect that's what this will be like. And look, if I'm wrong, today's April 11th. So I will do an update at the end of the month. We've got a lot coming up. CPI, a lot of economic data, all the big companies, all of them, the big banks and big tech. And that's all that really matters is big tech. But the banks are kind of a tell on the economy too. So I think there'll be those earnings that are coming up Friday will be important. But then again, by the end of the month, you're going to have Apple, Microsoft, Alphabet, Amazon, Tesla, Nvidia, and so I think we're at a critical technical juncture. And I'm going to wrap the video up here. Showed you a lot of charts, but I'm showing you that the majority and my most reliable and accurate long-term indicators are still on sell signals, and as such, I am, giving, and again, I try to also differentiate swing and short-term trading positions, which I'm really not even talking much about lately. I'm back into swing trading mode, at least my long-term accounts with swing shorts. And when does that change? Well, like I said, at the end of April, we start putting up, green candles and green histogram bars and all that. Then hey, maybe something else is going on, and most likely I'll be stopped out before then, because that's going to be pretty powerful if you get some solid green bars up through there. I don't swing and even trend trade off that. That helps formulate my longer term view. But on the 60-minute chart, we have those nice divergences. Let me go back to QQQ. You have like divergences. You have those nice divergences on the daily chart of QQQ and all the big FANG stocks. And so if these start getting taken out, it starts on the 60 and then it'll go through on the daily. And so one by one, if the bulls get additional check marks, then then it's time to start reducing short exposure. But as of now, just want to show you that's my view. And again, the takeaway, if you have a different view, no problem. You can see 313.62. You want to call it down to 312 if you want to be safe on the daily chart. Really good support. You go much through there, I think that's I know that'll be a false breakout right there. But even if you want to continue to buy, then your next level, if you're a bull, well, we'd have support around here at about 303.20, and then you have this 200-day exponential, the 200-day simple. The bulls, quote unquote, should be buying. If we drop down to the 200s, they should buy another back test of those, like they did right here, right? But if they don't, then that's just another check mark for the bears. And obviously, that's what I think is going to happen. I've laid out my longer term targets. I showed you that on SPY. I have different boards, but weekly chart, I give you those targets there. Let me see what other boards I have. Yep, I gave you that fib cluster. That's around 320 on SPY, about a 20% drop. And I could go on and on. I've got different boards, different targets. This is a long-term chart. This is if things get real effing ugly target, final death of the great secular bull target, end of the secular bull target. And That's kind of a, we'll see if we get there. Right now, this is what I'm looking at, and that aligns with that 20% drop. This is my SPY monthly chart, monthly trend, first target. And again, I think this is going to be, I think we're in the early stages of a new secular bear market, but there are going to be plenty of bull market rallies, bear market rallies, and most likely, if and when we drop another 20% and get down to my target, I can tell you right now, the folks that want to buy this rally don't want to short it, you're going to be wanting to short here. You're going to think the world's coming to an end if we get here, and you're going to want to, you won't want to buy. I won't be buying unless the charts tell me to buy. Just because we hit a target, most likely I'll be covering shorts there, or at least lowering stops. But I just wanted to let you know, this is, I always try to think 3 steps ahead. I could tell you right now, if we get down to that target, it's going to be ugly. You probably won't want to buy. And like I said, if the charts tell me to buy, that's where I cover shorts and I buy, and then I'll game a rally, and at some point I'll be short again. And I can't tell you right now how high a confidence I have that we're going to, that's if things get ugly. Target 2, second target, which is going to take us down from where we're at now, another 47%. All right, guys, let me wrap it up here. That's enough bear fodder for you. I'm sure I probably shouldn't even show you those targets. But that's, again, that's where I think things could ultimately head. But let's worry about today, tomorrow, next week. Let's get through this month, and then we'll have a better idea. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.